Hey, hi everyone. Welcome back to the Lloyd Academy Asia Pacific, Middle East and Africa Educational Program 2024. I'm Janice Chung, Head of Market Development for Lloyd's Asia. So today's topic is on fraud and claims, a review of the past year. So please note that the session is going to be recorded and will be made available on the YouTube channel, which is Lloyd's YouTube channel. So as a disclaimer, the views and opinions expressed in the webinar are those of the speakers and do not necessarily reflect the official policies and positions of Lloyd. The information provided is intended for general informational purposes only and should not be construed as professional advice. With that, I will hand over to our moderator, Jonathan Ung, Global Political Risk, Credit and Bond Underwriter at AXA XL. He's also the Head of Political Risk and Credit Development Group at Lloyd's Asia. Over to you, John.
Thanks, Janice. Thank you, Lloyds, for organizing this and for having us and for the very kind introduction. As mentioned by Janice today, we're covering fraud and claims, the last year in review, and got a pretty nice panel of speakers here. Got Ian Anderson, who's in the midst of joining the panel right now. He's experiencing some technical issues, unfortunately, but
I'm here. Hello, everybody.
Oh, hi, Ian. Yeah, Ian is a highly experienced insurance lawyer who specializes in resolving complex international insurance and reinsurance claims. His work has a particular focus on marine, offshore energy, trade credit, and commodities insurance. So Ian typically represents international insurers and reinsurers and is an associate mediator with the Singapore Mediation Center. We have a fellow insurer with me on this panel. It's Jamie Taylor from Chaucer, past underwriter for the credit and political risk side. Jamie has been working in credit and political risk space for over 20 years, spending time at Catlin, Texel, Talbot, and now looks after the APAC book for Chaucer in Singapore. Myself, as introduced by Janice, heading the political risk and credit development group at Lloyd's and also an underwriter in the credit and political risk space with AXA XL. And last but not least, we have Tim Bradford being the CEO of Leadenhall Adjusting with about 40 years of credit and political risk claims experience. So, right, as Lloyd mentioned, or rather as I mentioned, a pretty star-studded lineup to talk to all of you here about both fraud and claims in the trade credit world. And of course, given it's a Lloyd's kind of like session, we'll definitely be linking it back to insurance somewhat. Before we go into the details, I just wanted to also talk a bit about the global trade finance market and a bit about how costly fraud can be. So based on one of the recent global market insights statistics, the global trade finance market is actually estimated at about $9.3 trillion in 2022, and it's forecasted to grow 3% annually for the next 8 years or so till 2032. So if we were to pause and kind of like think about it, 1%, let's say 1% of that overall trade finance volume is kind of like susceptible to fraud, and say about 10% of that amounts to actual losses to the industry. We're looking at actually a pretty alarming $9.3 billion cost to the entire trade industry. And fraud tends to always fall into one of these buckets that you see on the right here on the screen, where documents or electronic documents tend to be altered or are actually fraudulent. And at the same time, documents can be kind of like destroyed as part of the hiding process, so to speak. But of course, trade finance still has to happen. Global trade finance gap being estimated by the ADB in a recent report stands at about $2.5 trillion in 2022. And at the same time, the rising kind of like geopolitical tension and uncertainty that we're seeing in this current time right now in the world results in a worsening of this gap. And that's also always where we always look to things like bank financing and credit insurance working hand in hand, non-payment insurance as a solution to this finance gap. So as mentioned earlier, definitely kick off with some insurance clauses to remind everyone of the mechanics of insurance policy wordings. Of course, not going to go in depth before everyone falls asleep, but you find it relevant as we kind of like walk through these clauses and also the entire session. So two main ones to start here. We talk about things like insurance clause as the main operative clause that basically notes that the insurer will indemnify the insured for the insured percentage of loss due to the failure or refusal of the buyer or the obligor to pay the insured according to the terms of an eligible shipment. And you see that part of this clause actually references insured percentage, which ties into a traditional kind of like requirement of most credit or non-payment insurers to retain some risk on the insured's own books. And at the same time, this clause also references a critical point being eligible shipment. And as you see at the bottom of the slide, there are variations to it. It could be eligible transactions at the same time, but more often than not, or rather, eligible shipment or transactions usually requires that there has to be a shipment of goods and that they have to be delivered to the buyer, so to speak, and as required under the contract of sale between the seller and the buyer. So I've covered one part. Probably post the next part, or rather, maybe a bit of a question for my other insurance expert on this panel, Jamie. So what are some other clauses that we as insurers kind of always place a little bit more emphasis on? And could you kind of like walk us through those?
Okay, thanks, John. So on to the next slide. So in a typical insurance policy wording, apart from the insuring clause and talking about what's actually being insured, which has been covered by John just now on the eligible shipment, just as a reminder, we're talking about a typical sale of goods or services that's being insured here. A fundamental clause in all of our insurance policy wording is the concept of knowledge, and that's fundamentally guided by Section 4 of the Insurance Act 2015. A lot of it is consistent with the definition of what actual knowledge of the insured is, matters which should reasonably have been revealed by the insured's customary due diligence. So what they will normally do, whether they're insured or not, what they will normally do before going into the underlying sales or loan transaction. Knowledge of the insured would also include matters which the insured suspected and of which they would have had some knowledge but deliberately refrained from confirming or inquiring about them. So this knowledge definition is important as it underpins a lot of the other principles of or intention of the coverage. It goes into the concept of disclosure or the duty of fair presentation of the risk to the insurers and also the warranties. Slide, please. The other important element of the policy wording or the insurance coverage is fraud, which is, I guess, ties in with the main theme of our panel here. And not to be confused with fraud by the counterparty. So we're talking about an insured making a fraudulent claim. If an insured makes a fraudulent claim, the insurers are not liable to pay the claim, and they may recover from the insured any sums that have been paid by the insurers to the insured in respect of the claim. And the insurers may also, by notice to the insured, treat the policy as having been terminated with effect from the time of the fraudulent act, and retain premiums paid. So, as I said just now, this is fraud by the insured, not fraud by the counterparty. So, if the insured colludes with the obligor and make a fraudulent claim, the condition applies. But if the obligor commits fraud, resulting in the insured suffering an actual loss, which, subject to all other terms and conditions of the policy, constitutes a valid claim, then this clause is not applicable. So this is quite an important thing that most of our insureds would get confused about, and it's important that we clarify that. Next slide, please. So I talked about knowledge just now and how it underpins some of the major principles of insurance. Warranties is something that's not a foreign concept to most of you, I hope. And in a contract of sale in a contract of sale which has been insured, the insured represents and/or warrants that the insured transaction is valid and legally enforceable, which ties in back to, again, earlier when John was talking about the concept of eligible shipment, which must be evidenced by a valid and legally enforceable contract. This is an imposition of the insured to ensure that the transaction legal enforceability is maintained throughout the contract and not just at the beginning. And the insured will use reasonable measures to prevent or minimize loss. The insured being one step closer to the risk, or us being a step further from the risk, we do rely a lot on the insured to ensure that the transaction is managed and conducted in a prudent manner, as if they are uninsured. And I think with that we've kind of highlighted most of the pertinent insurance clauses and concepts when it comes to non-payment insurance. And then I think it's a good time now to hand over to Tim. I think it's storytelling time really by Tim. Give us some trends and updates and events on what's happened and what's been keeping you busy.
Thank you, James. Thank you. Very nice to see everyone. Thank you to Lloyd and for the opportunity and the great joy of working with Jamie, Jonathan and Ian. Well, we're having quite an interesting year. We're going to come and talk about fraud more specifically. I think the most interesting thing maybe for you guys is that fraud is by no means limited to the Asian market. We're seeing frauds throughout Europe, North America and South America now, and a particular prevalence of fraud probably in Dubai. So there is quite a lot going on. In terms of the volume of claims, though, we are concentrating in terms of most classes of business now in Russia. There's some in Ukraine. We also have PV claims sadly in Gaza and Israel and elsewhere where the trouble spots are pretty bad, particularly Ukraine. The whole area of fraud has been a big concern to us over the last couple of years because the frauds have changed. Historically, we were a class that had relatively little fraud. We worked with basically nice people and things didn't seem to go wrong very often in the fraudulent field. We now have a full range of frauds coming in this year and last year. We've now had 3 insureds who are completely fake. So underwriters have been presented with an entire transaction which is fictitious. And in one case, the underwriters actually met the guys who are perpetrating the fraud. Very interesting now that people perpetrating these frauds know our market, and they're very often practitioners who have left the market. So the degree of sophistication is very high. And we're seeing that in terms of when they break in with fraudulent documentation into an otherwise legitimate chain. But often we're finding that really it's the increase in IT. People can create documents or buy documents and then falsify them in a way that historically they never could. So from an underwriter's perspective, When you look at a piece of paper, it may look like a bill of lading. It may even be shown to the principals involved in that transaction, and they will not spot that it's fraudulent. And this whole growth of fake domain names, for example, has transformed the ability of people to commit fraud. And we're seeing it on quite a large scale. So probably at the moment we have about 160 cases worldwide where there's the suggestion that fraud is involved, which is enormous because we're a small practice. So that represents a very significant change from, say, 5 years ago, where we may have had one. So it is very problematic. Just in terms of non-payment, though, briefly, South America had been very quiet until 6 months ago. Now that's picking up. In Africa, we have the sovereign defaults. Zambia and Ghana, number one. I mean, they're producing a volume of claims. They're not fraudulent. These are big banks working often with government buyers, but they're a significant volume of claims. And in terms of this ex-pro market or forced abandonment, Russia is leading the way with a number of very significant claims in the hundreds of millions, and they're going to be very complicated and take some years to sort out. So, Jamie, that would be my immediate thoughts.
Right, thanks, team. Yeah, I guess besides like trends and events that you could see, again, pretty much storytelling time for both, I think, for you and Ian at the same time. Maybe you can talk about some of the experiences or specific cases that we see that are maybe a little bit more well-known in the industry, so to speak.
Of course. I mean, do you want me to do that, or would Ian? Would you like to talk a little bit about it from your perspective as well?
Sure. Well, I just wanted, in terms of storytelling, I guess there's just two experiences that we've had in the last year that I think are very interesting. One is that I had recently had conversation with a trade finance platform that do all sorts that people come to when they finance all sorts of transactions. And I was asking one of the principals of the trade finance outfit, you know, what was going on with people seeming to recycle and reuse bills of lading across the Asia market. And this individual was quite clear to me that there is an active market in basically renting out your bill of lading to others so that they can then use that to manufacture commodity transactions purely for financing purposes. And you're all aware that the financing for that transaction is usually only in place if there is a non-payment insurance that sits behind it. And somewhere in Singapore, there is a coffee shop or probably, sadly, a KTV lounge where it's probably like a Blockbuster Video. You can go and just rent a bill of lading for whatever commodity you like for a number of days, and then you can then use it to set up whatever number of circular transactions you can, and getting finance for each of those transactions. And the scary thing is that can all be legal. If it's done correctly, that can all be absolutely valid, enforceable, legal, and insurable. And there is, I think, a significant risk there. It's just, in some respects, it's a complete Ponzi scheme just to get finance, but it can be done in a legitimate manner. I suppose the second experience just wanted to share is that there is, I think, increasing, certainly in the marine cargo sector, there is increasing fraud. The insurers are suffering increasing fraud, whether it's phantom cargoes that were never there in the first place, and are therefore not insured because they never attached, or as we've seen with Quadra, with the Quadra commodities collapse, that we've had insurers insuring cargoes in silos, on-land storage, and it was just taken. It's just completely misappropriated. And I think in many marine open covers now, misappropriation cover is pretty standard. If you can produce the paper, you can get your claim paid, subject to sublimits. But marine open covers are very wide, very broad. You often don't know what you're insuring because you just agree to cover the entire stock and the entire turnover of the trading house, and therefore they have been much more open, I think, to abuse in the past 12 to 18 months. But those are my two experiences, really.
Ian, what I think we would say is quite interesting to think about at this stage is what is causing the people to commit fraud. And of course, there are some criminal elements, people who want to take advantage of either you or banks. And in some of these circular frauds, of course, you as insurers, that you are the only men of substance in the entire transaction. So you are clearly being identified as a potential victim of this fraud. And that can be just for straightforward criminal purposes. And on average, we would say that the average fraud of that size we're seeing is between about 5 and 20 million US dollars. So it's significant, but within the terms of our market, not so enormous that you're not going to get away with it because it's so large. The other area we're seeing significantly, and it affects Asia and also South America, is people starting to commit fraud because they're very worried about losing face because their family firm has got into trouble, maybe on the back of COVID or other financial difficulties. And they start off in a small scale, just trying to keep people employed, to keep the business still running. And then it degenerates into sometimes very significant fraud. And then almost always ultimately the company will end up failing. But it's quite interesting that there are two very distinct groups of fraudsters that we are seeing. And the criminal fraudsters, we would say, are particularly prevalent in the Middle East and in some Asian jurisdictions. But Asia and South America for the family protection type frauds, as well as the renting the documents. We heard that in Singapore you could buy for $10 pretty much anything you liked. And they were being photocopied off in shipping offices and pretty much sold at the door and were pretty freely available at one stage. And in terms of more sophisticated chains of documents, and here we can see the bills of lading, all sorts of shipping, quality documents, the whole package of the documents for that transaction. We've identified 3 factories, 2 in Dubai and 1 in London, and you could go and buy a complete set of false transactions. So that's on a shipment by shipment basis. Obviously, when you're getting to a fraudulent insured, everything is fake. So fake domain names, addresses, emails, all sorts of things. So, and that's on an incredible scale. But in terms of volume business, we're seeing these factories able to produce significant numbers of transactional documents very quickly. They're incredibly hard to prove whether they're true or not. And some of them have had emails which are so subtly different from the real email that we've gone to some of the major trading houses and said, is this your transaction? And they've said, yes. I said, just check the email. And it turns out there's just one letter, slightly different font, maybe a comma suddenly injected. And in the old days, that you would have picked that up with your security on your computer. Now you probably won't, because they will have a fake domain name which is linked to a real website. So when your computer says, is this a real website? It is, but it isn't the website you think you're dealing with. So you might think you're dealing with, for example, Trafigura. It looks like Trafigura. Even the Trafigura guys will say that email is mine, but we look behind it, it's not. But it is buttressed by a genuine domain name, and that's a way of getting through your guys' systems. The other very common one is just changing account details. So everything is right on the face of the document, but the account has been substituted for a fake account. And then if you try and follow that money, it disappears off to the British Virgin Islands, almost immediately, and you lose sight of it. So the sophistication of these is really amazing.
We've got some time for Q&A later, but I've just got one question now, actually. Tim, like, how, these stories that you've uncovered, how much of this is still going on, that are just trudging along and not discovered?
Well, we rather fear that there'll be quite a lot, because we're a trailing indicator, so we're only looking at claims when they're happening, and sometimes it takes quite a long time to unpick these. So some of these investigations, and we use very sophisticated investigation tools and investigators, but it can take a long time to unpick it.
Yeah.
And because of this new trend where you guys are the focus of the fraud, so in the early days there'd be a fraud, and probably the main intention was to defraud a bank. Now there's an intention to defraud insurers, because your product is well known, it's much more well understood, and you're very vulnerable because so much of your due diligence is in essence is done in arrears, and there's a trust that if you've got something from a very well-known insured, it's likely to be true. We had one chap who turned up with an insurer and casually dropped a copy of Time magazine on the desk, and there was a picture on the front. He said, "Look, I'm the Young Entrepreneur of the Year," and everybody was amazingly impressed by this. But actually, he just produced this off his own back. It wasn't a real Time magazine at all, and it's an extraordinary thing how these guys are spending a lot of time thinking about how to get your money. And with computers nowadays, you can create almost anything. There's a whole range of people out there who now know that in any given transaction, the guys with the heavy credit rating are you, and they're looking to get your money.
That's a bit depressing for Jonathan and I, but
Unfortunately, there's a lot of it. It's
yeah,
and I think if you keep it small and you're not too greedy, a lot of it will pass under the radar and it won't get looked at because
exactly.
there isn't, it's just not worth the risk carrier's time to, or especially if it's a subscription market. If you keep it small and you're not too greedy, there is a fair chance that it can get passed through on the nod. I've got to say that the best we had a very suspicious mega yacht claim. This is not last year, some years ago. The owner of the mega yacht set up their own fake websites for various companies to show themselves up as a billionaire, and as an owner of cobalt mines in Africa and owners of 737 private jets, and it was all so laughably bad. This is before the wonderful days of Adobe and Photoshop, things like that, and it was hilarious, absolutely hilarious. He eventually got caught by the Swiss authorities for invoice phishing and was banged up in jail, and we had to negotiate the settlement with him in his jail cell, which is quite interesting. But it's just, look, the gumption of some people, what people think they will get away with. They'll, it's businesses often whatever people think they can get away with, I'm afraid.
Actually, on that, it's a nice segue into how people got away with something in the form of, I think, one of the high-profile claims that we've seen. I can't remember now. Is it 24 months ago, 12 months ago? John, if you don't mind moving on to
about 2 to 3 years ago, I think.
Yeah.
So super high profile name. If Ian or Tim you'd like to share a bit more on the whole kind of like experience, and also at the same time difficulty of proving a fraud, really.
Well, I would say about Greensil's, I've not been involved in Greensill claims, thankfully. I know Tim's heavily involved, so he's quite probably limited as to what he can see. But this is a great example of somebody coming up with a product, and which was, we'll buy your receivable invoices, and then we'll insure against not being able to recover on them. It's a product where they just realized they could unlock capital within the supply chain, and it got to a stage where they were unlocking capital for invoices for goods which hadn't even been manufactured yet. I mean, it was completely uncontrolled and unrestrained. But it just shows the cash flow for many businesses. They're purely willing to use whatever financing opportunities they can get to just keep their cash flow going. And it is a ongoing Ponzi scheme of just making sure you've got enough future transactions and invoices to get further financing that you then use to pay off the previous financing. That's been very prevalent in claims that I've worked on. I think it's for Greensill. I think it's really just a product that was developed to fit a gap that was there, and at a time when there was huge desire to provide cheap financing. This is before our inflationary period and interest rates rising, and many sort of banks and financial institutions, if you said to them, look, we can guarantee you'll get a 6% return on a 180-day payment period, and they never default, they'll just go, great, where do I sign? Thanks very much. It was, sadly, it was too good to be true.
Greensill is an interesting case. For anybody who's really interested in it, there's a very good book called Pyramid of Lies, written by an author called Duncan Mavin. And I would strongly recommend you read it, because it's absolutely fascinating as to how some very clever people tried to take advantage of the insurance industry. And it's quite fun. It's not a heavy read, but it's very well researched and is substantially true from what I've seen. So it's well worth a read. But what you had with Greensill is this chap who was so clever that everybody fell in love with him, and he ended up having an office in the Treasury in London. Despite the fact that almost every one of his previous adventures had failed gloriously, he just convinced more and more people that he was right. And then he got together with Sanjeev Gupta, who wanted to make his fortune in the steel industry by buying up essentially pretty derelict works and converting them into green energy steel works, and everything sounded lovely, except for, of course, they would never make any money, and Greensill didn't actually have any money to lend. So to make this multi-billion-dollar industry work, he realized very early on that he needed credit insurance, because when he was packaging up his debt, he was selling it to individual wealthy investors and sovereign wealth funds mainly in Switzerland, and they wanted to see something of substance. And the only thing of substance in that transaction was the insurers, because the steelworks were of no value. The banker had almost no money. He described himself as a fintech, but I'm not giving away any secrets here. He's not very new, and he's not very IT literate. He's pretty good with an Excel spreadsheet, but that's the limit of his tech. So the whole thing is just an absolute fabric of smoke and mirrors. But it worked because the guys buying the debt at the bottom, who were providing the real cash, could see an insurance company involved and therefore were prepared to risk their money. In the end, that was worth something like $12 billion of money was put in on the strength of insurers' creditworthiness. But what the insurers didn't know, and what the Swiss didn't know, is that it was all a fiction. So the documents that they were relying upon had been made up, or as Ian said, even more extraordinary, they were based upon an algorithm of what might happen. So you were insuring something that may happen, and then you were selling that product as something that may happen to a man in Switzerland for real money. And so there's real victims here. Some of them are sovereign wealth funds for whom a few billion isn't going to make much difference. But there are individuals whose life savings are here. So there's real victims here. The lawyers are having an absolute field day. There's cases in Australia which they think will last for 10 years. You'll be able to follow, if you're interested, that the brokers are being sued. All sorts of people are being sued. And the amounts of money involved are just simply staggering. But the whole, in using Duncan Mavin's example, the whole pyramid of lies sits on one truth, and that is that the insurance companies were decent people with good credit ratings, and it would not happen without insurers. So once again, you guys are front and center. You're not peripheral to Greensill.
Yes,
Yeah,
thanks.
Yeah, and it's probably also a good example of how difficult kind of like fraud can be proven in a lot of these. I mean, we all know that at the end of the day, it was uncovered that it's somewhat fraudulent. But yeah, again, it took so many. I mean, it's still ongoing of sorts, the entire case. So yeah, maybe something for you, Ian, is probably also to kind of like enlighten us further on how kind of difficult.
I think, like all lawyers, I'm not going to deliver the bad news. Sorry, guys. Which I once went to give a presentation about an offshore energy policy with a Japanese insurer to their clients, and I pitched it terribly wrongly. I told the client about what I thought all the problems and the gaps were in this policy, and I hadn't realized that the guy I was with was trying to sell that insurance to his customer. So very polite Japanese man came out and said, "Oh, Mr. Ian-san, maybe next presentation not so negative." So alas, this one is a bit negative, right? Everyone's very quick to jump to the conclusion, oh, it's so bad, something terrible happened, it must be a fraud. It must be a fraud. But what I want to get across to everybody here is that proving that something is a fraud, is a sham transaction, is extremely difficult indeed, because the law is very, very clear that in order to establish that the underlying transaction is a sham, you have to show that both parties that all parties to that transaction knew it was a sham and had a common intention that the transaction documents would not create any valid legal rights or obligations, but would merely give the appearance of creating a valid or enforceable sale. So to prove a sham, you've got to get the evidence that both parties were aware that what they were doing was fake and had been created purely for the purpose of trying to obtain financing and then get the insurance for that financing. There have been, in the last 12 to 18 months, there have been several cases in Asia, 2 in Singapore and 1 in Australia, where the defrauded company, whether it's a bank or it's an insurance company, has tried to say that they're not liable to pay out under their letter of credit or under the insurance policy because the underlying transactions were a sham. In the Credit Agricole case and in the Winson Oil case, they related to letters of credit that banks in Singapore had put up to fund the purchase of bunker oil, heavy fuel oil, for which Singapore is the largest sort of gas station for ships in the world, or one of the largest at least. And it turned out in both cases the transactions themselves were fake. In the Credit Agricole case, the bank tried to say, well, I don't have to pay out under my letter of credit because the transaction is fake. The court said, well, actually, on the evidence that you presented, only one of the 2 parties, yes, it was a fake transaction, but only one of the parties knew it was fake. You haven't proven that both parties to the sale transaction were acting fraudulently. And actually, on the evidence that you presented, we conclude that the party who's claiming on this letter of credit has in fact been the victim of the fraud, and therefore you're not entitled to set aside the letter of credit on other grounds. The court, fortunately, in that case, found another basis on which to set aside the letter of credit they couldn't recover. The Winson Oil, the court did find that all the parties knew it was a sham transaction, that it had been created based on forged documents purely for the purposes of trying to get access to financing. The Australian case is BCC Trade Credit, where the insurers BCC argued that they weren't liable again because they said it was a sham transaction. And the court said, well, yes, the transaction was fraudulent. It was the collapse of Phoenix Commodities globally, leading to a huge amount of defaults. But again, the court found that the insured, Thera Agri, were not in on the fraud, and therefore it was recoverable. They also tried in the BCC case to say, well, on the sale documents that they presented, it's not clear that title in the documents ever passed from one party to the other. Therefore, it wasn't a sale. And if it wasn't a sale, it can't attach to this policy. And the Australian Court of Appeal said, well, actually it can, because what you were insuring was not the underlying transaction. You were insuring non-payment of the Sharia compliant financing transaction which sat on top of that sale. And that wasn't fraudulent, even though the underlying sale was fraudulent. And on your policy wording, the transaction you insured was a different transaction that defaulted, and you've got to pay out underneath it, under it. So you had to be very, very careful as to defining first of all, if you're going to say it's a sham transaction, you've got to have very, very clear evidence. You don't get a smoking gun. You just have to dig away to get the evidence, to make an overwhelming picture. And it does have to be overwhelming. And there's an awful lot of conscious bias. It says, oh, it must be, oh, look at this new document. It must be fake. It must be fake. And then you send it to the barrister, say, we got the new evidence. We've got the new evidence. And the barrister says, Ian, that doesn't say anything. And you get very, very deflated when the barrister tells you that you haven't got a case for fraud. You go, oh, that's not fair. Trampling on my strawberries yet again. Okay, so next one, just very quickly, where you can be saved, next slide, very quickly, where you can be saved, however, is you might not be able to show the transaction is a fraud or a sham, but you may be able to show that the transaction documents with which you are presented are so defective that it doesn't amount to a proper sale of goods, and your policy only responds to non-payment under the insured transaction. The insured transaction is a sale of goods insured, a contract for the sale of goods insured, goods delivered to the buyer under the sale contract. And that's what the usual wordings will say for eligible shipment. So for it to be a valid contract of sale that can attach to the policy, you need to demonstrate that title and ownership in the goods has transferred. First of all, you need to be able to demonstrate that it was held, that title was held by the seller and then passed to the buyer. And secondly, you have to show that possession in the goods was held by the seller and passed to the buyer. And transfer title can be done by contract. In your sale contract, you can say, I transfer title in the goods to you, the seller, 3 minutes after we sign the contract or upon signing of the contract. But transfer possession can only really be done by physical custody and delivery of the original bill of lading, because that's the document which entitles the holder of the bill of lading to get possession of their goods on board the ship or in the container. And that is why the original bill of lading is such a key document. It's the biggest red flag. Whenever an insured on any claim says, I can't produce the original bills of lading, we only ever transacted on copy bills of lading, that is a major, major red flag, I think, for all of us. But if you can show that the underlying transaction that you insured, or the non-payment of which you insured, actually was not a valid sale contract, and your policy required the insured transaction to be a valid and enforceable contract for the sale of goods, as described in the policy, then even if you can't prove fraud, you may be able to say, well, I'm sorry, none of these transactions attached to my policy. So it's very difficult to prove fraud, but even if you can't, if the documents are defective enough, it's possible that they might not attach to your policy in the first place. That's all I wanted to say on the sham stuff. Thanks.
Yeah,
Thanks,
that's
Ian.
interesting. And one of the problems we just keep coming across all the time is that the insured just says, did I lend the money? Because often we're seeing either an aggressive loss payee with rights to present a claim, or we're finding a bank as the insured and they say, did we lend the money? Yes, and they can prove it. Did we get the money back? No. Is that a legitimate banking transaction? Regardless of what happens underneath it, you guys are on the hook. And in some arbitrations, I'm afraid that's proved to be entirely persuasive. And that's desperately unlucky for underwriters, because, of course, if you are paying out on what amounts to a fraud, you're not going to get any recoveries. The legal costs, obviously, and all sorts of pain and suffering you go through to get to that stage. But it's proving a very effective defence to a lot of the banks, which then comes back to, well, who did the due diligence on these guys in the first place? And I'm afraid that's a world of misery we don't have time for today. But if they said it was the underwriters and the underwriters said it was the bank, and the bank said, I thought the brokers had done it. And the reality is this guy, we had one glorious case of a dentist buying 50,000 tons of steel. Well, you'd have thought in the ordinary course of his business, it was unlikely that he needed steel at that quantity. But nobody had bothered checking, because everybody was looking at everybody else to have done the due diligence.
Was that a bank insured or?
Yeah, it was more of a finance house than a bank, but it was a financier. Yeah.
Okay.
They said, "Oh, we don't do much due diligence. We think our underwriters do it."
and then the underwriters think that the banks do it.
Yeah, and in any event, the dentist didn't exist, to be honest. So.
Brilliant.
Yeah, brilliant. Yeah, so well, I guess.
Yeah, that again brings us to the next the last slide, I guess, nicely.
Nicely, as you said, yeah, not all doom and gloom, I guess. There are some lessons to be learned out of all of this. And also, I think just opening up to everyone else. I mean, rather, for all four of us can probably chime in here. So maybe some questions of sorts, like how can we kind of like then prevent such things from happening based on experiences and trends that we're looking at. Maybe if any of you would like to share.
You want to bring up the next slide? Yeah. I mean, if I could start, it sounds like for insurers, as Ian and Tim alluded to, the risk selection process is key. pre-acceptance of the risk. We really must know who our insured is, and if we, going back to that very recent point about trusting that someone's done their due diligence. When we have the insured being a lot closer to the risk, we definitely rely on them to do the right due diligence, and to trade with the right people, and to ensure that the transaction is managed in the proper manner. I picked up a lot on what Ian said on the insuring clauses and definitions, in terms of definition of eligible shipment, and how the definition of contract of sale has to tie in with a few important elements that need to go in there. It must be legally enforceable. There must be transfer of title. There must be transfer of possession. And so what I want to ask Ian is a typical insuring clause and a definition of eligible shipment or insured goods or insured transaction. Is that sufficient at the moment, the common ones that you see? Or do we need to go all the way down to, you have to make sure that it's evidenced by original bill of lading, and just go, how long is a piece of string to make sure that we catch all the elements?
Well, I think it's a very good question. I think there's two things there, Jamie, and that is, if you're doing a straightforward, where it's the actual commodity sale that the non-payment under that is your insured transaction, then yes, you definitely want to be describing the goods insured in the policy schedule as a physical sale of goods. Because that means that a paper or a pure financing sale where there isn't proper transfer and title and possession cannot be an insured transaction and cannot attach to your policy. It becomes more difficult where what you're insuring is not the non-payment under the underlying sale, but you're insuring non-payment of the loan of the underlying transaction. And this goes back to Tim's comment, where the actual insured transaction being the loan or being a bill of exchange, for example, some form of promissory note, that even though the underlying sale transaction upon which the financing was based or on which the bill of exchange is based, even though that underlying transaction is false or a sham, the transaction which you insure is valid and legally enforceable, and therefore an insurer will be held to it unless other terms apply, or they can show that they're insured as the issuer, I guess, of the bill of exchange will, or it's in their favor. They will, unless they're deemed to be complicit, then you'll have to pay out underneath it. So tighter language, I think, is needed in the policies for where you're doing the financial transaction, as it were, rather than the underlying transaction.
Yeah, agree.
Thanks, Ian.
Note to self.
Yeah. I guess at the same time, on the insured side, probably a few insureds on this call, not too particularly sure, but pre-acceptance and post-acceptance of risk, I think we mentioned things along the line of, say, copying of bills of ladings, copying of invoices and things like that. Technology has made it so much easier to do that, but at the same time, I was chatting to a few kind of like banks yesterday, and they also mentioned how technology actually helps them prevent some of this type of fraud or fraudulent cases, where in the pre-underwriting phase they typically use AI or technology to kind of work through things like network analysis or relational links to the actual obligor or the actual buyer, and to find trigger points where they could probably investigate a bit more and find out where they can dive deeper and understand if there's any form of probable fraud before they even accept the case. And post-underwrite is also the usage of technology and data to, at the same time, formulate some form of early warning signs or collection forecasts and things like that to help them understand better cash flow wise, or if there's any, say, probable fraud along the way.
I think the difficulty is that these are all transactions which everybody wants to work. everybody wants to happen because it generates income. Everyone's getting a turn on it. So my advice for the insurers and the brokers is, step back, try and just when you can, just step back from the fact that, yeah, we all want this to work because everyone's making money off it. Just step back and try and have an objective view on what it is that's being presented to you. And, and don't just, the biggest one is when the documents look like it's an in-house document. The commercial invoice will always be issued by the seller, but if everything else, whether it's certificate of analysis, certificate of quality, packing list, all the usual things that standard financing documents might require to be produced in order to draw down on the finance, if it becomes very clear that they're not independent documents that were issued by the original shipper, but they're issued by somebody simply on their own in-house headed paper within the trading chain, then that shouldn't be the case. That really shouldn't be the case. That tells you that the genuine shipping documentation is somewhere else.
Right, thanks, Ian. I guess that brings us to probably our last line. Asking for a friend. This is where you kind of like don't say that you have an issue, but ask at the same time. You're asking for someone. Yeah, in essence, Q&A. If anyone has any questions for the panel.
Jazril. Fantastic. Definitely a
Hi,
question
Jess.
for Tim then.
Yeah.
Oh,
Can you hear me?
Yes, you can now.
yes.
Well done.
Hi, thanks for the very interesting session. I actually have a couple of questions, and I just wanted to find out if the figures and the data that was presented on the slide, most of that, is that proven fraud, or would you say that they are, like objective evidence of fraud, but not proven?
Look, I don't know those numbers, but I would suspect that it's a very conservative estimate. It's not all, the vast majority of it is not going to be proven because only a very small percentage really comes to light. But I think one can, those bodies, I think it's in that case, the Asia Development Bank, I think it is developed those figures. And I think they are able to make a fairly educated estimate as to what percentage of transactions could be considered to be suspicious and fraudulent.
Yeah,
Right.
the thing is specifically proven. This was just a thought process of whether, if we think about it, like 1% of the global trade might be susceptible to fraud. It's just a very minuscule percentage, but if you think about it in actual quantum, we're talking about like 9.3 billion in total cost. But I don't think that's specifically a proven number of fraud cost to the industry at the moment. But yeah.
Right. So, I mean, I get that, proving fraud is a tall order. There's a lot of things, especially from an insurer perspective, for us to prove, and it's a very high bar. But say we have objective evidence on hand, and at the end of the day, we aren't able to kind of meet all the trigger points for it to actually be a proven fraud. How does that typically get settled? Would that be like an, out of court negotiation of some sort?
Well, I would say quite often it's very rare that you'll have, even if you've got objective evidence, it has to be particularly overwhelming so that a tribunal, an arbitrator, or a judge, and bear in mind they're really, because in effect they're reaching a decision that the customer has acted criminally. They need to be very, very satisfied of the evidence before they'll reach that conclusion. And if it falls short, they just say no, it's not. I'm not going to make a finding of fraud. What you might get, however, in the alternative is that where the evidence of conduct is slightly suspicious, but you cannot prove fraud on both sides, the tribunal, the court, may still be influenced in making decisions against the insured on cover on the other terms of the policy, the other obligations that they would have. as to due diligence, as to sharing knowledge, as to preventing and minimizing losses. So you might not have the smoking gun, but it can still support the tribunal reaching the view that on other policy obligations it doesn't meet, that they haven't been met, and therefore the policy isn't engaged.
Right. Okay, thank you. And my last question would be, I mean, I saw that you raised a lot of issues around the purchasing of fake documents. And typically how does I mean, we have marine open covers as well, and lots of cargo silos and all of that's covered. And how in those circumstances, I mean, the claim volumes are high. How do you typically identify easily a fictitious document? Like what's the surest way that an insurer can kind of conclusively say that, yeah, that this document's fake? I mean, everything is electronic documents these days, and it's sometimes it's really hard to tell from a genuine document from one that's fake.
Yeah, you're absolutely right. I think that it starts always, I think, with the bill of lading, and saying to your customers, to the insurers, okay, this has now happened. There's been non-payment, right? I need to understand fully how this transaction worked. I need to know that you bought and owned this cargo and you delivered it to someone else. The best way to explain that, to prove that to us, is to show us the custody record of when the original bill of lading came into your hands, when you bought the cargo, and then when the original bill of lading, how it got into your buyer's hands when you sold the cargo to them. That is, I think, the most important. If they can say, yeah, sure, not a problem. Yeah, here is our custody record. This is how we got it. It was held by me here, and then I delivered it on to them. Here is, here are the courier receipts here when we send it across. If they've got that, then that's a major green flag and positive to say, okay, this looks like it was. Some of the trades are registered on international databases. There's a Singapore trading database, I think, as well. So you can go, there are independent international databases where you can sometimes also verify that the trade occurred. Certain customs authorities also keep records of original bills of lading when they've been tendered at the discharge port. You can try to build up a picture. What you're trying to build up is a picture which says, well, we now know exactly when these goods were shipped and when they were discharged and when they went into the warehouse at the end user. And you're presenting documents and a bill of lading with dates that are completely outside of that. So you cannot have bought and sold the goods which had already been delivered to someone else. If you can prove the impossibility of the transaction that they're presenting to you, Jazril, it gives them a huge amount of explaining to do. What we would call once a bill of lading has been submitted and they've collected the real goods, that bill of lading is spent.
Yeah.
It has no value, has no purpose,
Yeah.
but it can still be used to generate false transactions or give the appearance of an otherwise genuine transaction.
Thanks, Ian. Thank you very much. Thanks, everyone.
Good.
That's all from me.
All right. Any other questions or? I think so.
Okay. Excellent. Thank you very much, everybody. Thanks
Thank
for
you.
listening.
Have a lovely rest of the day.
Enjoy,
Thanks,
guys.
everyone.
Cheers now.
Thank you.
I think.
Take care.
Yep.
Bye.
Well, thanks to our speakers for sharing the insights, and also for John for doing the moderation for today. So I hope the virtual audience all enjoy the session today. And I'm going to share my screen up. So I'm going to display the QR code so you can leave some feedback for us. Thanks again, and enjoy the rest of the day.
Thank you.
Thanks, everyone. I'll sign off. Take care. Bye-bye.
Thanks,
Thank
everyone.
you.
Bye.
Bye-bye.